Joining us is Ernesto Ramos, portfolio manager at BMO's Low Volatility Equity Fund. Ernesto, we're kind of stuck right now in this market and the economy where we're trying to get rid of the virus and move on, but we're still in the middle of the biggest lockdown that we've had yet and the worst curves that we've had yet. So even with the vaccine backdrop improving our future, we still got a lot of the same stuff going on here from the last 8 months. What's that mean in terms of how you're thinking about the look ahead? Should we focus on the future or the current?
Well, I think the market always focuses on the future, so you want to focus on the future. You're right, we've hit a rough patch here. We can see the clear road ahead because thanks to the vaccine and the vaccinations that are taking place, and we can see that the road is clear, but we're currently in a rough patch. But we really have to focus on the road ahead and the clear patch. And we think that GDP growth for 2021 is going to be pretty strong. It'll depend on exactly how quickly we can get everybody that we need to get vaccinated to achieve the infamous herd immunity. But we know that's going to happen. So we want to tilt our portfolios now to be more exposed to cyclicals and to the value part of the equation, or to the value part of the market, because that's what's going to benefit in a strong economy. And at the end of the day, it's going to be earnings driving the stock market. And if you think about 2020, we had about an 18% earnings decline for the S&P 500. We're going to get about a 30% bump in 2021, which translates to about a 7% from the previous peak growth. So it's actually a pretty solid earnings story for the market as a whole. And like I said, you want to tilt it right now to the more cyclical value part of the market.
Ernesto, in your portfolio, we've talked about some of your holdings for a while here on the show. Walk me through what you are taking away from to add onto the cyclical side. Is it detracting away from some of the stuff that has been considered low vol in the quarantine environment? Is there cash that you've had on the side that you're just putting to work now, or bolstering positions in companies that you like from a value perspective? Walk me through how you're expressing that view, because it does sound like a little bit of kind of a newer kind of optimism post-vaccine that you're expressing here.
Yeah, we still want to retain some of the stocks that are done well, that will continue to do well, that are still considered defensive. For example, Walmart. Walmart is done very well because people are staying at home, buying more everything through buying their groceries and everything to eat more at home and not go out and so on and so forth. But you want to get exposed to, for example, AGCO. AGCO is a company that sells farming and equipment, and their worldwide sales, 60% of their sales go to Europe, 25% North America, and the balance is split between Latin America and Asia. And this is a company that is clearly going to do well in an environment where you have pent-up demand for equipment, you have depleted dealer inventories, as well as higher crop prices. So this is a pure cyclical play on the crop price cycle and the economic cycle. So this is the kind of company that will do well in the new environment. And it's important to notice that you want to also play the fact that the disparity in valuations between growth and value is so high. It's at the highest we've ever seen it in our data. So you also want to make sure that you're not totally in the growth part of the economy. Nothing wrong with these companies, but they are so priced for perfection that any slip and you're going to see them take a big hit, and you want to be a little bit more defensively from a valuation perspective positioned relative to the growth, so the pure growth stocks in the market.
Ernesto, your pick this morning, AGCO, is one we've actually talked about here for our afternoon overlooked stock block, a company that is, I think, generally kind of underappreciated in its cyclical ties. I'm curious, when you look at the valuations for some of these stocks, they've had a really nice run since the vaccine. Some of them, like AGCO, had already gotten back to their pre-COVID levels months prior to the vaccine. How does the process for gauging valuations in a cyclical-oriented company differ from those growth stocks where it seems valuations really are no issue? I mean, if these companies do rally enough going into the recovery, does it make a high bar for the economy to live up to?
Well, at BMO Global Asset Management, our evaluation of stocks is very comprehensive. We take about 24 metrics for every stock. Some of them have to do with valuations. Some of them have to do with their fundamental strength. And by fundamental strength, that means growth prospects and quality. And so you're willing to pay up for higher quality and higher growth, and you're not willing, you're willing to pay less for lower quality and lower growth. Now, AGCO has higher quality, higher growth. It trades at 21 times. That's not very cheap, but it's not terribly expensive compared, for example, to some of the higher flying growth stocks, albeit its growth is lower. Therefore, we're willing to pay 20, 21 times for a stock that's going to grow into the coming economic cycle. Because we've done that work in terms of offsetting the higher quality, higher growth relative to the multiple we're willing to pay in our comprehensive approach to evaluating the stock from both a valuation and its fundamentals perspective.
Ernesto, you mentioned Walmart earlier in terms of having one of these companies that's consumer focused, but it's also done very well during this period. We've talked to Kroger before. That performance in the stock has been a lot worse than Walmart lately. How do you figure out what is going to survive in terms of the kind of pseudo staples of this period? It seems like Walmart has a very different type of appreciation on Wall Street right now than a company like Kroger does.
Yeah, the Kroger fundamentals are not as strong right now as Walmart's are. I mean, Walmart, for example, is effectively competing with Amazon in the online market with Walmart Plus. They also have the incredible footprint that their stores give them. So they're better positioned to compete in the online market. Kroger is not as well positioned for that market. They're more purely defensive, more purely exposed to groceries. Walmart's product lineup is much wider than Kroger. So in that respect, right now, Kroger's is not looking as attractive as Walmart from a fundamental perspective. But again, you have to trade off that valuation. And so our analysts are constantly looking at those metrics and seeing what it gives in terms of how much have the fundamentals deteriorated versus the price and the valuation that you're going to pay for that stock. Because for every stock, there's a price, no matter how lousy that stock might be, unless it's going bankrupt, of course. But if that stock's going to be okay in terms of having a future, you want to make sure that you're not overpaying for the fundamentals, however good or bad those might be. We tend to own companies with higher growth, higher quality, and as they deteriorate, that's when we're going to be selling them. Now, I'm not saying anything about Kroger in terms of selling. However, we're evaluating the fundamentals of that company right now to see whether we want to hold it going forward.
Okay. All right, so you're taking a second look at Kroger right now. Still like Walmart, definitively. Ernesto, thanks for the update here. Always a helpful conversation as we try and figure out what type of companies benefit from the environment, which is always changing in the background. Ernesto Ramos is a portfolio manager at the BMO Large Cap Value Fund.